Hello everyone, thank you for keeping it with us. I want to thank you wherever you're watching us from. But also I want to employ you to share this video to your colleagues such that we can understand taxation concepts, accounting, financial management, auditing and other aspects together. Now, today we want to look at rental income tax. Rental income tax. You could be there and you have property. And when we say property, we mean specifically land and buildings. But also if you have come to learn that you can also own a certain asset, not a land and building, and you give it out. And therefore if you're earning from it as a landlord, then there is a tax that is computed on that rental income, and that is what we are going to look at today. The key terms we have to first understand, one being the rental income itself. Two, we have to understand the meaning of landlord. Then three, the tenant. Now, rental income is the rent derived by a person for a year of income from the lease of immovable property. Specifically there we are talking about land and buildings. So if you rent out or if you give out your property, and in this case we are talking about land and buildings, if you give it out and you're getting rental income on annual basis, then that rental income is subjected to tax, and this form of tax is called rental income tax. Two, the landlord. The landlord is the person who rents out immovable property to another person. And when you talk of a person, the person can be an individual. In the last video, we talked about individuals. The person can be a company. A registered company by law is an official person. A person can be a partnership. A partnership where two or more people come together to do business in common with common objective, but with the purpose of making profits. So if that partnership is there and it gives you an asset in exchange for rental income or for consideration, then that partnership becomes your landlord. Then a tenant. This is a person who occupies another person's property on commercial terms, and of course there is consideration. They're equals to a tenant. A tenant can be a company, a tenant can be an individual, a tenant can be a partnership, a tenant can be a retirement fund, a tenant can be a government agency, a tenant can be a trustee. So, provided that you are the landlord and you have given out your asset, whether to a company, whether to a partnership, that category becomes the tenant now. Yes. We are going now to look at the computation of rental income. Now that we have understood these key terms, first of all, there must be an asset. Two, this asset is given out at a consideration. The terms you agree on must be involving two things: giving out an asset, but also the tenant must pay for using that immovable property. So we are going to look at the computation. Specifically, we want to first look at an individual. We have looked at an individual in the last video. We want to see if you are an individual like Tom. Individual, example Tom. In the name of Tom, an individual can be Dennis, Tom, Dennis, an individual can be Joshua. That is an individual. First of all, you need to first determine the annual gross rental income from all sources of an individual. So an individual could be having a house here. Let's assume maybe in Kenya. An individual could be having another house somewhere maybe. Now, what we do, we first look at all the geographical sources of rental income of this individual, provided this individual is a resident individual. We look at sources of his geographical. We look at all the geographical sources. Now, let's assume maybe here, let's assume the annual gross rental income is 100 million. So now, we are just assuming 100 million as the rental gross income. So here what we do, we deduct the threshold. The threshold provided by the law is 2.82 million. 2.82 million. Let me go here. Trace it from 100 million. Then what remains is subjected to 12%. So if you can get 100 million minus 2.82 million, what remains is the chargeable income, and that chargeable income is subjected to 12%. I think that one is clear. For an individual, that is what you do. What you need to have in your mind is first to get the gross rental income for the year. You raise the threshold. They assume that maybe for you to get this 100 million, maybe you incurred some expenses. Maybe you incurred management fee, maybe administration, maybe you incurred bill, maybe you incurred security expenses. So now they are bundling all those expenses as 2.82 million. So rest that figure from 100 million. If at all maybe the gross rental was 100 million, what remains is subjected to 12%, and that one is the rental income tax for an individual. So nowadays, the rental income tax return is submitted separately, and I think in the coming videos I will show you how to file rental income return and how we pop in the figures from the rental income computation. So now let us look at now in an individual. In an individual can be something like a company, so can be something like a partnership, like that. So, however, for a partnership, I will prepare a full session talking about taxation of partnership, because the treatment of partnership is quite different. I'm going now to prepare a video about that, so that we can understand all the aspects. So what you do, the step one, you also first do what? You also first determine the gross rental income from all of the sources of the company. The company could be having maybe land somewhere, could be having buildings somewhere. What you do, you total up, you bundle all the income from rents in year of income. Then 2, after getting it, you deduct 50%. We are not saying you deduct 50%, but you deduct all the expenses, all the allowable expenses that relate to the property. Maybe the company could be spending money on maybe security, could be spending money on utilities, maybe it could be spending money on repairs, it could be spending money on maintaining all of those. But the law says it shouldn't, all those expenses or allowable deductions shouldn't go above 50% of the gross annual rental income. No. If it goes beyond, then it will bring questions. So now, you raise 50% or below. You look at the expenses incurred or that are related to the rental income, less them. But they shouldn't go beyond 50% of the gross rental income of the year. So after getting that, what remains is subject to the 20%, 30%. 30% times the chargeable income. The question is, how do we get the chargeable income? We get the chargeable income by getting the gross annual rental income minus up to 50% of the expenses, but also some losses may come in to get the chargeable income. Then what happens? You get 30% times that chargeable income. So now, if maybe we can now get an example here, then we see how it works. Let me offer here an example such that we can really see how it works. Example. Now, assuming that maybe total rental, the gross rental income for the year, this estimate is 100 million. So now let me put this in a bigger font, such that we can really see it properly. Good. Now, assuming the gross rental income is gross rental income, assuming it is 100 million. Now, we are saying that you raise we are saying you raise 50%. 50% of that, of course, is 50 million. You raise 50 million. If you are raising that, the chargeable income now, chargeable income becomes 50 million. So now, the tax payable will be, let me call it rental tax payable. Now it will be 30%, 10 times 50 million. That is how it works. 30% times 50 million. So that one will give us as you the traetment here, 30% will be now 15 million. Will be 15 million. But that is now the rental income tax, and that now the person getting gross rental income of 100 million. I mean specifically a company getting rental income of 100 million. This company will end up paying 15 million as of course the rental income. So that is how you compute. If, for example, you have a company, that is how you compute if you have a company. So if it is an individual, now it becomes different. It's an individual, it becomes different. For an individual, you look at, you are going to assume the same year that maybe an individual is earning 100 million as the gross rental income in a year. The law says the threshold of 2.82 million. Then what do you remain with? What you remain with is before the chargeable income of how much? 100 millions. Tell me what is out here. 100 millions, but minus 2.82. We are having 97 millions, 0.18. And 8,180,000. So this is the chargeable income. This one is the chargeable income. So now the rental tax payable. Rental tax payable now will be 7% times the chargeable income here. That's one thing. That's times the rental. Times the chargeable income. So to get now, let us work it out here. And then time was the 0. Get 11 million 601,600. So you can see now that an individual pays less. Was we had gotten 15 million as a company, but an individual will pay 11.661 million. So that is how we compute rental income. Okay? Next time we shall come with another video showing you how you find rental income return, how you pay. That section will be separate. If you find this video useful, make sure you subscribe and like, but also share video calling such that we can understand taxation concepts together. But also, you can give us your feedback from the comment section such that we can make improvements in the quality of the services that we offer. Thanks so much. May God bless you.